Good evening, everybody. My role, at least for me, is refreshingly brief, and on behalf of you, I can say that's good news too. I'm Ted Platt. I'm head of the Global Markets Financing business here in EMEA at Merrill Lynch, and my task is simply to welcome the IAFE back to Merrill Lynch again. We very much enjoy having them here for the sessions that they run here, always stimulating, always interesting, and I hope tonight will be the same. It also gives me particular pleasure to introduce Giovanni Belliossi, who has been a client of ours and a friend of ours for many years. And so, without further ado, I'll hand over to Giovanni. Welcome, everybody.
Thank you. Thank you, Ted, and thanks to you and to Merrill Lynch for once again hosting us, us being the International Association of Financial Engineers. My name again is Giovanni Belliossi. I'm a hedge fund manager, but I'm not here in my professional capacity, but rather in my capacity as a board member of the International Association of Financial Engineers, one of the three London-based board members, the other two being Mark Hansen of Hermes, and who's not here this evening, and David Rowe of Sandgard, who's instead here this evening. Where's David? He's down there. And it's a great pleasure to have yet another London event, and yet another one sponsored by Merrill Lynch. They've been very kind again in their support of our initiatives. The IAFE is an organization that really has its roots in academia, in quantitative finance, and certainly many of our events are quant events. Not all of them, though, and especially I would like to stress, not all of them are of an academic nature. We'd like to mix rigorous quantitative studies with practice, and we'd like to look at the practitioners' arena, especially in the fields of risk management and investment management, in a broader sense than just limiting ourselves to pure, hardcore quant management. Just to give you an idea of that, we have this premium called the Financial Engineer of the Year that goes to the most prominent practitioner in the area of quantitative finance for each year. And last year, the last prize that we assigned was to Jim Simons of Renaissance, who will be familiar to many of you, who is certainly very preeminent and eminent in academia. He has a couple of theorems to his name in mathematics, but also very prominent in the business field as a hedge fund manager, a very, very prominent hedge fund manager. The other person who's here representing the IAFE is, of course, its Executive Director, David Jaffe, who's here and who's masterminded this event and a number of others with great skills. And David will be here to answer your questions, and I'll be here as well as Dave over drinks at the end of the event. I've already said that we have a number of events in London. The organization is still mostly based in the US, and the majority of events are really run on the east coast of the US and occasionally on the west coast as well. Having said that, we have a very active London group, and we plan to organize more and more events of a quant nature, or like this one, of a more general nature. It is a particular pleasure to host an event on operational risk, very timely, very interesting, and in a number of ways, some obvious and some may not be obvious. And this event is really a London-based staging of an event that we have hosted in New York, and was a very successful event there, and most of the speakers that we have today were parts of that event. So I'll thank you for being here. And just before introducing the moderator of today's event, let me remind you the press policy. That is one of, this might not admitting the press in the first place, but if there's any member of the press in the audience, so they're not, I'm afraid, welcome to report what's happening here, but they're welcome to approach the speakers, if the speaker so wants, and have one-to-one conversations with them that they can, of course, then report to the press. The other thing that I should say is be aware that the event is video recorded and will end up, I believe, on our website. The cameras are pointed towards the podium, and so if you ask questions, it won't be, I guess, it won't appear on the broadcast, but certainly we want to make you aware of that. Well, without further ado, let me introduce the moderator of the day, Al Perrins, Managing Director of PAMCO, and a partner of PAMCO, Pacific Alternatives, would be familiar to a number of you. He is a member of investment management and strategy allocation committees of a firm that is a very prominent firm in the alternative space. Before being at PAMCO, he was an associate director at Barra Rogers Casey. Again, that would be a firm that would be familiar to many of you. So, with great pleasure that I cede the podium to Arpa.
Thanks, Giovanni. Good evening. Just wanted to start the panel with a brief introduction of panel members. Maybe if you could start with Jill, your role in the firm and your background of the firm.
My name is Jill Ike. I'm the Managing Director of Adaptive Alpha. We're based in Chicago. We are a research and development company. I'm a former chief operating officer in the asset management industry. We develop analytics that cover the whole spectrum from decision-making, risk, all the way through to infrastructure.
Okay, great. Raiko?
My name is Raiko Nahum. I'm the CEO and founder of Amber Partners, and we are an operational risk certification firm. We basically certify the operational risk of hedge funds. Prior to founding Amber in 2004, I was the head of UBP's Global Operational Risk Due Diligence function, and I created that for them back in the mid-1990s, and have spent the majority of my career basically evaluating the operational risk of hedge funds and advising managers and investors on operational risk due diligence issues.
Okay, David Aldrich from Bank of New York.
My name's David Aldrich. I work at the Bank of New York. The Bank of New York is a specialist securities servicing provider, and I'm responsible for the services that we deliver to hedge fund and fund of hedge fund managers around administration, custody, and any outsourcing requirements they might have.
Perfect. I want to start the panel with a general overview of what operational risk means in the hedge fund land, what is really different from traditional asset managers or even private equity, why operational risk is so prominently talked about in the hedge fund industry. Maybe if you could start with David, then go left.
Sure. I think that the issue of operational risk in hedge funds is very different to traditional managers for a very simple reason, and that is that the hedge fund industry has traditionally been much more secretive and less transparent. And I think this is changing, but the industry is changing because of the demands of investors. And so what we're seeing, very simply, is a sea change in what people are looking for from the hedge fund industry around the issues of valuation, operational expertise, the use of outsourcing providers, and some of the issues that have arisen have been due to either too close a relationship between an external party and the hedge fund manager themselves, or between a self-administered fund and some of the practices that go on within that management company not being completely transparent. And these issues are different to the traditional world because in the traditional world you have generally less complex instruments and a different approach to the trading that you can make as an investor in and out of that fund.
I agree with David's comments. I think that when you look at risk fundamentally, you can look at it in two categories, those being investment related and those being non-investment related. What hedge fund investors have traditionally done when they look at due diligence is look at, first of all, the investment side, evaluate the merits of the investment strategy and the risk management surrounding that strategy, and then the operational risk has been everything other than the investment stuff. So when we look at the operational risk of a hedge fund, we look at 5 categories, being the manager's organization and the policies and procedures within that organization, including things like compliance policies, disaster recovery. Secondly, we look at the fund structure itself. Thirdly, back office processes and controls. Fourthly, valuation. And finally, independent oversight. And I think that, definitely I agree with David in that operational risk has become a very heightened issue and topic within the recent years because of the inflow of institutional investment within the marketplace and because of some of the blow-ups that we've seen in the industry.
We have a little bit different perspective. We look at operational risk as the failure to carry out the investment process. That's our approach to it. Because we believe that the common denominator across all managers are their business processes, and that allows an evaluation perhaps through a lens that allows you to look both at the granular level as well as the enterprise level. And so we don't make that type of distinction in looking at risk, whether it be investment or operational, because we believe the interdependencies make that a tough two buckets to put together. And so we look at kind of coming from the orientation saying that the investment process is what you're trying to execute, and all of the business processes supporting that need to be executed to have that work. And so our thinking is that as you're trying to get your arms around operational risk, if you really think of it as the execution component of the investment strategy and the investment process, it allows you to account for those interdependencies. And with the institutional assets that are coming into the hedge funds and the fund of funds, they are used to very sophisticated business processes, being able to see them, and that's what they're expecting. So I think that's what's shown, put the light, if you will, on the hedge funds to be able to kind of have them articulate what their business processes are, how they work, and it's just questions that they have not been asked before. So they're fielding them for the first time.
Interesting. So Jill, related to that statement, you were the head of chief operating officer at one point in your career. So what is really...
As a child prodigy.
What is really... what does really mean separation of duties between portfolio managers and really the operational part of the business? How much interaction do they need to have? And what was your experience there?
They interact very closely on a daily basis. That's the reality of how our businesses operate. And the control component of it is the separation of duties. Control is for people to have their area of expertise, to be able to say, this is our policy, this is what we normally do, and to kind of raise their hand when they've strayed from that, whatever the policy may or may not be, whether it applies to valuation, compliance, risk management. And so those two groups, the investment team and the business teams, if you will, interact at every level every day, and they're all following their own processes. And that gives them that rich experience to be very nimble and react very quickly, because they're both bringing their expertise to it. But it also brings a control function by virtue of the fact that they have different responsibilities on their shoulders.
So where does the really buck stop by? Who really has the final say on an operational matter?
On operational matters, usually it comes down to the chief operating officer. I mean, if it escalates and people disagree, it's the chief operating officer who has to step in and kind of say, this is our firm policy, this is what we're doing. And so it usually will be the chief operating officer who will have to make that call. Very often portfolio managers feel very passionate either about pricing, a way a specific security should be priced that differs from the policy, and they try to build the case. But at the end of the day, you have to think of the client and the fact that you will have to go and explain why that change was made. And so it's usually the chief operating officer who has to make the call.
And Raiko, what's been your experience in conducting operational due diligence on hedge funds? Do you see a clear separation of roles and clear accountability when it comes to operational matters?
I think that from an investor's point of view, it's very important that the operational due diligence function is separated from the investment function. because oftentimes those two things can conflict. You can have a great performing fund where you've secured the capacity, and then at that point it becomes very difficult to obviously think about operational risk issues. Usually it's one of these things that is an afterthought more than at the forefront of everybody's mind. When you do operational risk due diligence, you're not thinking about what can go right. Your first framework of mind is what can go wrong. So I think that those two functions should be separated from an investor point of view. But just to add to Jill's comments in terms of segregation of duties within the manager's organization, definitely I think one of the two most important areas to segregate are obviously the front and back office functions. The back office should always take ownership of the trade confirmation reconciliation process, so that you can never have a situation where a trader has stuck a trade ticket in his drawer, especially when he's trading OTC derivatives. And then secondly, to have that segregation of duties as to, on a daily basis, how securities are being valued within the organization, and then externally within the firm, what the process is to independently value the securities at each month end.
And David, from an administrator's point of view, do you tend to interact more with the operations, but do you also have any interaction with the portfolio managers itself?
It varies according to each individual management company. I think it's very difficult when you're talking about the hedge fund industry to generalize, so I'll go ahead and generalize anyway. But you've got small companies which clearly, when you talk about segregation of duties, you're talking about segregation of duties between people who may be a very, very small number of people, a handful of people who've all worked together before, who know each other very well, and who may be very good friends, and who certainly are economically very interdependent. In the bigger firms, as those firms grow, clearly there are growing pains, and you tend to get a greater segregation of duties. And as a service provider, clearly, if you're, let's say you're an administrator, you're signing off on an NAV, you need to be certain that the valuation contained within that NAV is accurate and that the trades reflect, as Reka mentioned, all of the trades that actually have been undertaken. There are no hidden transactions. So it's if the question is the segregation observable? It certainly is observable, and you're looking for good process, and you're also helping people create that process as they grow, because you've often got very, very brilliant investment professionals who may not have a great deal of operational experience, and they may not have a chief operating officer, a genuine chief operating officer at the time of the firm started. So you can, when you're close to the organization, and I think if you have somebody come in as a due diligence professional, you can go in and you can understand how the firm operates, and you can observe the processes and procedures, whether it's small or large. But certainly, it's very, very important to have that segregation where possible, and if there isn't a good segregation of duties, to be able to look underneath the bonnet and see how things are actually functioning on a day-to-day basis.
That's an interesting comment. I'm just wondering if bigger funds give any extra level of comfort or concern versus smaller startups, or just starting with two portfolio managers, one chief operating officers. They don't have a compliance officer, they don't have a controller, CFO. But as they build their asset base, they might be getting those people on board. But depending on the complexity of the instruments they are trading as well. So if you compare, maybe Reiko, if you could chip in, on a credit-based manager who's just trading, I don't know, CDO tranches versus some sort of an equity market neutral manager who's just trading highly liquid, listed securities all the time. So is it really comparable size and also strategy-wise, or do you have separate criteria when you compare those operational due diligence processes?
I think operational risk is oftentimes dependent on the complexity of the strategy and the size of the organization. And I have certainly in the past seen a hedge fund manager manage over $1 billion with 4 people. I give all credit to them, and they have implemented the basic operational controls and procedures that you would expect to see, but it's all listed stuff, and there's not much to do in the back office, and therefore you can understand how they've set up their organization, and they've also outsourced a lot. On the other hand, I have seen very complex strategies where a lot of derivative instruments are being traded, and you need the people in the back office to, even if you outsource, to oversee the outsourced service providers and to make sure that you are following up on the trade breaks, et cetera. So I think that it very much depends on the nature of the trading strategy as well as the way in which you decide to set up your business, whether you decide to take on those functions in-house or whether you decide to outsource a lot of those functions.
And do you rate them differently depending on the strategy?
Well, we make sure that we have taken the complexity of the strategy into account when we look at the reasonability of the controls and procedures in place. So just going back to the segregation of duties issue, if the manager is trading all exchange-traded securities, obviously it's not such an issue that there may be a weakness in segregation of duties between the front office and back office. On the other hand, if they're trading extensively in over-the-counter securities, at that point, yes, you would want to see definitely a segregation between the front office and back office because of the ability to potentially hide a trade ticket.
Jill, any comments?
I'd like to comment, and maybe it's my 80s coming from the trenches, scars showing. But I think the segregation of duties is sometimes misleading because genuinely in operations, it's the talents of the individuals and the processes that they build for the firm, I think, that keep the firm in good stead, more so than something like the separation of duties. And oftentimes, particularly firms that are going through big growth periods, they believe that now they need to bring in more controls and more separation of duties, but unfortunately there's some unintended consequences where their business processes can't withstand that. And so it's one of those things that sounds, in theory, that segregation of duties, would sound proper and good, and it is, I think, theoretically. But in practice, every firm has a strategy that is somewhat unique to that firm, and how they execute that firm is also unique. And so the combination of the business processes and the skills that they have behind it, I think, are the core things that really can tell you the most about that firm from an operational perspective.
I think that's a very good point, Jill, because one of the industry practices which is probably less prevalent today but was common in the past was, if you like, the franking of an NAV by an external party. So if you like, an artificial segregation of duties, exactly along those lines, so that there was, you'd have what we call NAV light, where you've got effectively an administrator saying, that's a good NAV. Actually, the NAV has been produced in-house. Now, it doesn't mean it's a bad NAV that's been produced in-house, clearly not. But what you need to see as an investor is, what sort of people have produced the NAV, how good are the operational people, and how good are their processes, rather than, that's been franked by an external party, therefore it must be good and must be better than an NAV which has been produced perhaps completely in-house without that process. And I think that you have to look at the way that people are behaving in reality as opposed to perhaps sometimes the clothes they wear.
Yeah, certainly you need to dig deeper than just looking at the pitch book and making sure that they are using a different administrator or different pricing source for each security. But just want to focus on valuation a lot on this panel. By the way, we are taking questions from the audience as well, so feel free to raise your hand and interrupt me. But on valuation, particularly, I'd like to focus on the disclosure of pricing policies, if they have pricing policies. And what are some of the best practices you're observing from each different point of view? Maybe start with Jill.
And so I would err on, having the most evasive general policy possible. I'm sitting in the COO chair. where the key thing in valuation is consistency. And I think that's your number one responsibility to your investors, that you be consistent in how you price. The price on any given day is less relevant than the procedures that you use to price your securities day in and day out. And I think that's what really goes to the heart of investors' concern, to know that there is process discipline within the organization to follow whatever the pricing valuation strategies are, and that there is some type of oversight and some type of indicator that would allow the firm to know when those procedures have been breached. And so I think that is at the heart of valuation, that it be consistent. Yep. Mm-hmm.
On consistency, so under normal market conditions, when liquidity is there, you could just mark your book easier than when liquidity dries up, right? Mm-hmm. So how do you mean by consistency? Let's say there's a shock in the system and things are not trading.
But that's so for when a shock occurs, that there is a procedure. In other words, this is what we do when we don't have these options, which is what we use in normal market conditions. We can do this. However, when we cannot do that because market conditions have changed, we therefore do this, and we do it consistently. This is what our backup plan is when this particular circumstance happens. That's where I think you get the real value of your procedures. And I think that gives great comfort to your investors, so that they know in these type of market conditions we have a plan. We also have a plan for when those conditions change or when we're forced to do something differently.
And some managers tend to write it on their offering memorandums, the circumstances where the NAV could be frozen. So they just don't really issue the NAV under different circumstances. So what are really the best practices those circumstances should be?
The best practices that I've seen, and I'm sure Mako and David have perhaps better insight, was for any change that goes against the normal procedures, that it be documented. It actually protects the firm as well as the investors. So if there is an exceptional circumstance, whether it be market generated or firm generated, something's happened, all of our systems went down, or we've lost our telephones, whatever the case may be, that it just be documented, because in our industry, disclosure is the key. That will always protect the firm. It'll always protect your investors. So disclosure is always the antidote.
Mm-hmm. David, any comments on this?
Well, I would recommend that anybody who hasn't read it yet reads the AIMA's guide to valuation on this topic, which some of us were involved with. I think it's 56 pages, so I won't read the whole thing now, but I think that, the key issue about this disclosure, well, first of all, you have to have a written pricing policy, okay, which is clearly not the case in every single firm. So you need to have the pricing policy, and then you need to make sure that the pricing policy is, if you like, rigorous enough that you can follow it, but not too rigorous that it creates exceptions the whole time and makes business not manageable. And exactly like Jill says, clearly when there are, and there always will be on actually a fairly regular basis for most funds of any degree of complexity, when there are exceptions, that they're documented, and that those are approved, preferably really by the board of the fund, so that as an investor you can gain access to that information. Because I think that pricing policies need to be followed to the letter to the word, and the spirit of the policy, and then exceptions documented.
Okay, very cool.
I think there's really three things that investors need to do to make sure that a fund has, first of all, as Jill mentioned, consistency. So whether you are taking the mid, the bid, the ask, the average of 3 broker quotes or 2 broker quotes, that is transparent and it has been applied at a point in time and over time to the various types of instruments within the portfolio. And that there are controls over cherry picking of broker quotes, so that one month the manager is not going to JP Morgan and the next month they're not going to Goldman Sachs. And that, as David said, that policy or process is transparent to investors, to the people within the back office, to the administrators, so that everybody understands how these securities are being priced. And I would say that in my experience of probably having seen somewhere around 600 to 700 hedge fund firms, I have never seen a hedge fund firm create a pricing policy that is so prescriptive that it talks about shock events. In my experience, what I see is firms that are following best practice pricing procedures and policies draw up a pricing policy that contains enough detail to say, here are the sources that we go to, and here is the methodology that we use to price these types of securities, and the